In this week's video, we'll review the latest charts and data to help us understand the good, the bad, and the ugly in the stock market. We'll be moving quickly, so feel free to use the pause button on your video player. We'll start with the ugly. XLK daily chart dated February 27th from the February 28th video, 20-day moving average all the way out to the 250. And significantly more concerning now on March 28th. Till something improves, this is a concerning look. This is a little bit better. Anchored volume weighted average price lines relative to the rally off the October 2023 low. We still have some areas of potential support close by. Chart as of the close on March 28th. Back to the ugly. Very similar situation. SMH, March 28th, highly concerning. Still, for the most part, in a trading range, the same trading range that we've been in for quite some time. However, there's no question this looks significantly worse over here from a vulnerability and trend perspective than anything else in this blue box. On the anchor volume weighted average price chart, nothing disastrous, but a subtle shift. We've never been below this red line tied to that October 2023 low. We've now had multiple closes below that line. Concerns would increase if we take out this line here, which is relatively close by. Bad news. From a trend perspective, in terms of a turn here, this looks like a much higher probability run at this downward sloping trend line. The good news would be we're still below that downward sloping trend line. Bad news, gold is clearly making higher highs on a relative basis versus these points here in 2022. Some potential good news for the GLD-SPY ratio. We're into that gap now. However, much like the previous chart, the fact that the ratio is above an upward sloping 200-week in red tells us the odds of clearing this gap are higher probably than they've been at any point in this area here. Also a good news, bad news chart, potentially. This is where the S&P 500 bottomed here in early 2016. This is the COVID low here. You can see the last leg up here, the last leg up here. It's possible that we're doing the same thing here. Having said that, we have to remember we have that 200-week moving average here that looks much better than it did here or here. We'll see how it unfolds. Similar situation here. Good news, bad news. The good news would be this point here, this point here, this point here, this point here, and this point here all coincided with improvement in the S&P 500 index. That would be the good news. The bad news would be to get back to that line, it would imply additional downside in the S&P 500. And during the session on Friday, we're coming right down to these important AWOP lines here. The further this ratio moves in this direction, the more concerning it would become. There's no question XLE relative to XLK looks significantly different relative to any point back here, and it's starting to look somewhat similar to early 2022. The good news would be, much like the utility SPY chart, at this point here, the S&P 500 made a stand. At this point here, the S&P 500 made a stand. So it's possible we could make a stand in a similar area and the correction would end. Again, having said that, the 200-week moving average is starting to turn back up. So we don't want to make any assumptions about anything here. On the good news front, unlike January 2022, where we clearly broke this downward sloping trend line, we haven't done that yet in 2025. The relative downtrend continues in small caps relative to the S&P 500, and that somewhat implies that interest rates could stay higher for longer. The relative trend of the equal weight S&P 500 technology ETF RSPT relative to VU, that is a stage 4 distribution look, and it's ugly. And if we look at the 200-week and the 300-week, this setup is almost the polar opposite relative to this cross here. If we want to switch back to a little bit better news, if we draw a trend line from this point here where the outperformance started in 2013 and extend it to this low here, you can see the trend. Sometimes we're above the line, sometimes we're below the line. We're back to that trend. And thus far, RSI looks similar to these windows in here. We had a slight overshoot on the XLK SPY ratio near this low in late 2022. If we move into this area here, concerns would increase. This is also a good news, bad news situation. I'm going to let you pause your video player and look at Dean's analysis here. His Twitter handle is here. The bad news, there's a lot of red in here for 6 months. The good news, 12 months later, consumer discretionary was higher by 12.64%, and Tech XLK was higher by 16.55. If you want a little bit of an offset, you can pause your video player here. Average gain a year later in the S&P 500, 23.25%. 88% of the cases were higher. Sentiment, this is the 3-week moving average of AAII bulls minus bears. You can see we've only been down there looking back to 1987, here in 1990, here in 2009, and in the present day only 3 times. Historically, looking out 1 to 10 years when sentiment is that lopsided, the returns are outstanding. You can pause your video player. That would be the good news. The bad news would be you don't want to make any assumptions about where we are in this downtrend. Why? Look how low the same line was in January of 2008. The S&P 500 didn't bottom until March of 2009. In terms of trying to be patient going into next week's April 2nd deadline, if history repeated itself, if it implies a favorable reaction to next week's tariff announcements. Not making any assumptions about that either. During the session on Friday, if you pause your video player, this looks better than 2022 and it looks better than 2018. The NASDAQ 100 relative to the S&P 500 has a breakout above this level here, and it's still above the 200-week moving average in red and the 300-week moving average in green. This can help with the sentiment a little bit. You can pause your video player. Here's the source. The concerning look would be, well, you get a green arrow here early in the dot-com bust bear market, and you get 2 signals here early in the financial crisis bear market. Having said that, the level of the indicator here and here, nowhere near where it is today. The similar levels today, that would be the good news. They come near the low after the dot-com bust bear market and near the low after the financial crisis bear market. You can see we have a green arrow here in the present day. You can pause your video player and read this little blurb here about next week from CNBC. This is the chart of the S&P 500 that we covered last week. This is the same chart during the session on Friday, and this is the close on Friday. Here's a zoomed in look at the same chart. Also noteworthy, we're going to cover a chart later in the video that shows areas of potential support, and they land right in this region here. Potential is the key word there. We covered these charts last week. The present day chart, high yield bonds on the 28th of March, really doesn't look anything like this here, January of 2022. Similar situation with the energy sector. Look at the run here and look where price is relative to the moving averages. Now look at the moving averages in the present day. We're not running in a fearful manner like this. In fact, we haven't made a new high in quite some time. RSP relative to XLK. At this point here, stocks did well. At this point here, stocks bottomed. Stocks did well. We're back to a similar area. Calls for some level of patience. If we move into this area here, that would be concerning. We went back up into the election gap as noted on X and Twitter this week, and right now that attempt is failing. Put this into the bad category. About the only good thing we can say about this chart, maybe there's 2 things. The slope of the 200-day moving average is still clearly up, and we have yet to make a lower low here, both calling for some level of measured patience heading into next week. Probably fair to say this short stay here in October of 2023 looks better relative to what we have in the present day. S&P 500 weekly, 50-week moving average. Put this into the concerning category. This one looks a little bit better. We made a stand here at the 300-day moving average. Still above it on March 28th, at least for now. This still in the present day looks a ton better than January of 2022 if you pause your video player. However, looking a lot more vulnerable. If we drop into this area here, concerns would increase. Pretty feeble attempt would be the bad news. The good news would be this is an area of massive potential support relatively close by. This is what it looks like when the secular trend is in doubt. This does not look like a secular trend. This is what the present day looks like. This is not a great look for the AI and tech trades. We would place this look here into the highly concerning category, especially if we undercut this low here. Haven't done that yet. Having said that, we do have a reference point and an offset on the AWAP chart. This is where the present day rally started here on this chart. You can see the present day rally has held above the green and the purple lines for the most part. We are still within striking distance of those lines, and even if they fail, we still have other reference points in this area here. Vulnerable? Yes. A complete disaster? No. Keep it in mind that this is growth versus value. It's also noteworthy that the monthly cloud of Russell 1000 growth relative to the S&P 500 is still checking all of the bullish boxes. It's probably fair to say the chart in March of IWM looks quite a bit different and worse than it did in January of this year. SCHG relative to VU, bad news is we lost this breakout. The good news is we have several potential reference points in this area here, and the ratio is still well above an upward sloping 200-week moving average in red. Here's a little ray of hope, SPY during the session on Friday. You can see we're still near this gap from July of last year. Concerns would increase if we undercut this low. Right now we have a higher low. And there's no question, the chart today looks worse than it has at a minimum for several months. You would like to look at this chart and say it's very, very easy to be patient. So if you went to a 60-minute chart and looked for a divergence on Friday around 3:30 p.m., didn't have it. In fact, relative to this low here in SPY that was made earlier this month, this is a bearish divergence in the short run. Tech Weekly has come back to the cloud. This is an area of possible support. You can see we did get a bounce here in 2022. If this chart here starts to morph into something more like this, concerns would increase. The fact that red and blue are kissing here, and the fact that we're back to the cloud, says this is still somewhat of an indecisive look. We don't want to sugarcoat it though. Highly vulnerable as well. You can pause your video player to study this. This is what a horrible stage 4 rollover looks like, where you take out the weekly cloud. We did it here, we did it here. And these are stage 4 scares where the position makes a stand at or near the weekly cloud. That did not happen in 2022. So we want to try to determine, does the present day look more like this, or this as we move forward, or this, or this? Exact same concepts with the stage 4 look on SMH. They don't all turn into disasters. Right now, we're still inside the green cloud. Concerns would increase if we get a weekly close below that green cloud. It's probably fair to say this ratio here is starting to look a lot more like late 2021, early 2022. Concerns would increase significantly if we move into this area here. Are there reasons to be patient? Yes, there are some reasons to try to be patient in a measured way, not a binary way for us. Covered this concept before. These anchored volume weighted average price lines are the date that the S&P 500 peaked in early 2022, the date that the S&P 500 bottomed in October of 2022, and so on and so forth. You can see the NASDAQ still near potential areas of support. The same can be said for the S&P 500 index. Hypothetically, if we came down to this line here, that would be a drawdown of approximately 14%. The other reference points are shown here. The average drawdown in a secular trend study that we did in the past, 13.13% within the context of a secular trend. 17 of the 24 cases, 71% of the time, the drawdown was 14% or less, meaning most drawdowns within the context of a secular trend make a stand somewhere between here and here. Approximately 71% of those drawdowns. Another reason to try to be patient. We'll see how it unfolds. Another reason to try to be patient, as noted earlier, we're still above an upward sloping 300-day moving average. And even NVIDIA has several areas of possible support in relative close proximity. In fact, we held here, and we're above that line now. January 10th look of this chart, energy relative to the S&P 500. If we look at the same chart today, somewhat of a mixed bag. This break here implies there could be additional downside in this correction if we move hypothetically back to this point here. The good news would be if you compare the ratio and the slopes here relative to January of 2022, the concerns about inflation are much more elevated here and noticeable than they are in the present day. Having said that, this is a notable change and it leans toward additional downside. The good news is, relative to the stock market bottoming here in 2022 and some positions in very, very early 2023, that trend still seems to favor tech over energy. From a probability perspective, that would start to change if we can get out to this area here. This area here acted as resistance here, and that's when the stock market bottomed in 2023. You can see this scare here in early 2022 on the weekly chart looks a lot more forceful than what we have in the present day with all this white space in here now. This too is a mixed bag. Ratio above an upward sloping 200-week moving average tells us we should be concerned about inflation. But much like the chart of XLE in isolation, we really haven't broken out of this trading range. If this ratio gets out here, concerns would increase significantly. Keeping an open mind, this is starting to look a lot more like this region in here in 2022. We talked about this chart in detail several weeks ago. We're not yet into the white space. We'll keep an eye on it. You can see in January of 2022, RSP, the equal weight S&P 500, started to significantly outperform SPY. We really don't have a shift look in the present day. And as weak as SCHG has been, it still has several areas of possible support in relatively close proximity. There's several gaps in this area here. That's why there's so many lines. You tie them to the gaps. You can see support, support, support. If we look at this range from here to here, hypothetically, this would be a drawdown of about 12% to here and about 14.5% here. Well within reason relative to historical drawdowns within the context of a secular trend. If this area doesn't hold, we have other reference points over here. This also tells us if we come back and test this line or this line, then we potentially have additional downside. This line, not all that painful, under 15%. If you get down here, you're starting to get close to 18%. At some point, you have to take some risk off the table, or this can eventually morph into 50 or 90%. Right now, this is a subtle shift, and it's a subtle shift in a negative manner until proven otherwise. If you look at our X feed, this type of candle here, that is not what we were looking for this week. It's a chart during the session on Friday. We probably ended up around here, so this is deteriorating. If this starts to look more like January of 2022, concerns would increase. This is easy here. This is a short stay. If we zoom in on this, not easy. This is a concerning look until proven otherwise. Weekly RSI has given up 50, and we're below the 30, 40, and 50-week moving averages. This still looks a lot better than January of 2022. And $ NAHL down here, this still doesn't look that bad either relative to January 2022. We're right around the zero line here. If you're a bull, you really would like to see this make a stand relatively soon. If not, concerning. Already concerning. This would be even more concerning. Still have an area of potential support, and these are kissing, telling us to keep an open mind. If this morphs into this, concerns would increase. Weekly RSI, this looks different and it's not good. This looks different and it's not good. This is concerning here because we're relatively early in this downtrend. It's possible this does look like January of 2022. Since 2014, this ratio has made a stand at or near an upward sloping 200-week moving average. We'll see how it unfolds. You can make an argument this could be morphing into something like this, except in the opposite direction. Still some basis for hope. Similar situation here. If you just looked at the ratio in isolation, it's still in an uptrend. The last thing it did was make a higher high. The 200-week moving average is flattish, and we're well below this high here. So you don't want to make any assumptions about what's happening next here. If somebody says we're going to go into a deflationary depression, this chart says otherwise. Probably fair to say this chart near the 200-week moving average is at a relatively critical juncture. Overshoots are not that uncommon. It's the long-term trend in foreign stocks relative to the S&P 500 during Friday's session. This is not a particularly encouraging look here. If we look at the AWOP, the bad news is we're getting rejected at the black line. The good news is this trend off of this low is still in place. So if we play ping pong in here, we need to know which way this breaks. This is the Eurozone relative to the S&P 500. This is China relative to the S&P 500. That's the 200-week moving average in red. Thus far, this chart looks better than 2018 and better than 2022. We've seen similar charts. This is just a different symbol. IVW in this case, relative to VU. This is IWY, relative to the S&P 500 with the 200-week moving average. This is global tech, relative to the S&P 500, the trend from 2016. Same trend for IWY tech since 2016, just a monthly version and above the 50-month moving average, the upward sloping 50-month. This is an ugly look here. But we did have a similar ugly look here, and it turned out all right for the S&P 500 here. This is 2013. This is 2013 with the S&P 500. QQQ relative to VU and or SPY still above a flattish 200-week moving average in red. Bad news is USMV minimum volatility is outperforming VU. The good news is resistance, S&P bottomed. And I should say that's the potentially good news because we don't know. This is possible resistance. Very similar concepts here. VONG relative to VU, 200-week moving average, still sloping up. Dow new highs minus new lows, dot-com bust bear market, financial crisis bear market, present day. Early 2022, present day. Early 2022, present day. Early 2022, January, present day. There are unquestionably ugly things to be concerned about. Having said that, we've also covered numerous topics that tell us to keep an open mind about the stock market making a stand in the coming days and/or weeks. And it's also possible, if we came back to common areas of potential support, that our drawdown could end up being 100% normal and to be expected relative to historical drawdowns. But we obviously don't want to make any assumptions, especially with some of the ugly charts that we've covered in this week's video. Hence why we've taken some incremental defensive action in recent weeks, and hence why we did not redeploy any capital during the recent rally. And given the April 2nd reciprocal tariff deadline is right around the corner, it's incredibly important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.